One of my buddies, this is why I love the folks in the asset management world. He sent me this text message as he was listening to it. It was like a Twitter screen capture, and it shows silver's like down. Let me see, it's like 35%, and
Yeah.
gold's down 12%. And the caption is like, "This is the biggest liquidity swing in human history." And I just kind of face palmed.
If you take out this AI overhang, earnings were great. It's funny because literally a year ago, everybody wanted to see big CapEx numbers. And if they saw a company not spending on CapEx, like Apple, for example, they would punish them thinking, oh, they're going to fall behind. And now we're at a point where, okay, now the number's too big. And now Apple's being almost rewarded because they didn't spend on CapEx before.
Welcome back, everybody, to the second episode of Inside the Flows. I'm your host, Yasu, and I have my special guest here with me, our very own Inflows contributor, Nishit Patel.
Good morning, Yasu. Good to be here. Happy Friday from the East Coast.
Yeah, happy Friday from sunny San Francisco Bay Area. Nishit, it's a real lucky week for us. We have the Super Bowl here in San Francisco, and a lot of my buddies are really excited about the events that go along with the Super Bowl, as well as their very own Super Bowl here within the last 10 years.
Nice. What, any big events, networking parties out your way?
It's really interesting. So the Super Bowl happens in the city of Santa Clara, which is about an hour and a half drive, but all the events happen in San Francisco. And most folks, understand San Francisco is like a big city, but it's really not. It's actually square footage. It's pretty tiny. So you could pretty much walk into any establishment in San Francisco and you're probably going to see a celebrity or you're probably going to see an event. It's really interesting. They usually have some type of parade too. So you could walk down to the Super Bowl Center and, just have a blast there. So we're very blessed to have this event, kicking off the year for us.
Nice. That'll be fun. Exciting.
Nice. So today's February 6th. This is our second episode. And Nishit, we had a really good first episode last week where, you and I talked about the weekly recap, and then we dove right into AI. And, I posted it on YouTube and Spotify and Apple Podcasts. And if you aren't a subscriber right now, please do subscribe and like. It really does help the show audience members. It's funny, going through the podcast last week, you and I started talking about gold and metals and how metals were kind of breaking through record numbers and whatnot. And after we recorded the show, I started editing it, and the metals got kind of vomited. It was one of those things where you just can't time the market, and that's even in the news. You can't time the market. One of my buddies, this is why I love the folks in the asset management world. He said after we released the show, he sent me this text message as he was listening to it. And he sent me this. It was like a Twitter screen capture, and it shows like gold and silver. Just silver's like down. Let me see, it's like 35%, and gold's down 12%. And the caption is like, "This is the biggest liquidity swing in human history." And I just kind of face palmed when he said that.
Yeah, look, these markets are going to move quick, right? So even as we're having a discussion between the discussion and the editing and the posting, things have moved, right? And even, I've got friends here in New York. A buddy of mine was trying to sell silver, heading over to the Diamond District, and he was like, "Nope, they're all full, right? They've got too much silver now." So it's like the response and the actions that consumers and retail investors are taking, it's real time and things move quick. Fear moves quick. As you can see, this week, even in the equity markets and even today, a little bit of a bounce back, but can't time it at all.
Yeah, absolutely. You cannot time it. And, we're going to have to tell our aunties and grandmas and moms to put the gold away during the weddings.
They missed their window to sell the gold and now put it back under the mattress.
Yeah. So that was funny. So our format, for those who are new to the show, is we do a weekly recap and then we jump into a special topic. So we're going to get right into it. You ready, Nishit?
Yeah, let's go. Let's do it.
All right. So Monday, we kicked off pretty much a crisis in confidence. There was a release by Anthropic. It was a new plugin that was called Legal, and it allowed the Anthropic, Claude Code to be able to handle legal matters. So you could create software that could write contracts and review them, or go through various other like legal aspects that kind of spooked investors of companies like Thomson Reuters and whatnot. And some of these stocks were down 10+%. So it was a moment again where AI is starting to put a lot of pressure on software companies that over the past year haven't really been doing well. And then, I'd love to hear your thoughts on when you saw that. I think they called it the AI anxiety
Yep.
case.
AI anxiety. Everyone's got anxiety these days, right? People and now the AI contributing to stock market fluctuations. But yeah, listen, it reminds me a lot of what was it last year when over the weekend, like there was a story on DeepSeek and how, we thought it was way better than the American AI solutions and then what it was going to do. There's this inherent fear of just AI and what it's going to do to the workforce and what it can do to profitability of companies. I'm still of the mindset that we're a ways away from there. And to me, we've talked about this even with financial advisors. Like AI is here to, I think, help to help prepare, to help in some administrative tasks, maybe some pre-game prep stuff. In the case of legal, you can see maybe yeah, it could be taking the place of a paralegal, of a legal assistant. But if you're about to close on a big deal, even if it's buying a house or selling a house, you're still going to want a human lawyer to kind of help with that. So to me, this is like how computers helped us do research, right? Maybe we don't go to the library as much and we do things on our computer. And then when the internet was kind of more available to everybody, to me, I look at this as a development of like AI is here to help assist us in things. I don't know that we're there at the point where there's singularity and it's going to replace all the law firms. I still think people are going to hire law firms to do work and hire consultants to do work like that. So this is just another step. I think that the panic and anxiety is oversold, especially in some of these stocks where software licenses could be impacted, but I don't know that the fundamentals are being deteriorated that quickly the way people were forecasting this week at least.
Yeah, yeah, I think I agree with you. I think if you're a lawyer or a paralegal, you're probably fine. I do worry though, Nasheed, about software developers or software development companies that provide services to these lawyers and paralegals. Because me and my own developer, we're starting to use Claude Code, and it's pretty good.
So let me
It
ask though,
can,
right? Is that
yeah.
replacing like legal when Legal Zoom came out? Did
I'm not
what
familiar with
happened?
LegalZoom. What happened with LegalZoom?
That's one of it was like a .com where you could go and get commonly used legal forms, so much cheaper than going to your local lawyer and getting forms out like that. It may be. I know it's not exactly apples to apples, but I think it's another step towards productivity and making things more available to folks. In terms of coding, definitely different, right? Like I think now you're hearing people do vibe coding and maybe there's shortcuts to actually hiring like professionals or software developers. But yeah, I get what you're saying. It's biting into some of that capability, right?
Yeah, I mean, the way I look at it is if you are a, professional service provider, white collar, you probably get emails or some sales rep saying, "I have this software that is a solution for you."
That's right.
And you get inundated by it. You look around, you're like, okay, all my competitors are using this software. I might as well buy it. It's industry standard. Boom. Here's my, monthly subscription or annual subscription or whatnot. I think with like Claude Cloud and this legal plugin, you don't have to wait for inbound requests to kind of boost up your own solutions or productivity with your own firm. You can just get somebody to build exactly what you
Hmm.
need
Hmm.
for your practice and pay, the $100 a month, for Claude Code, and then whatever you'd pay like the engineer. So I think that's kind of that's the new future that's coming in, and
Yes.
that's what spooks Intuit and Thomson Reuters, because I guess things can get a lot more. It looks really good for a business owner when you can basically build anything you need versus here's something I need, plus I got to get 10 things I don't want, and then I got to pay the full price for that. So I think that's the kind of future that small businesses and even large enterprises are going to see with this whole AI revolution.
Yeah, I agree. I think it's, look, it's a step, definitely a step up from the digitalization of, websites, marketing, communications, everything that we kind of went through in maybe the early 2000s. This will have more of an impact on jobs and services provided, but I'm still of the belief that hopefully it creates productivity. Certainly, there's going to be specific companies that their value proposition is going to be taken down a notch or even wholly replaced by some of this AI and vibe coding, to your point. So yeah, we'll just have to see who the winners are, at least from a marketplace perspective, see who comes out, right?
Yeah, yeah, absolutely. The other thing that happened on Monday was that there was an exclusive report that came out by the Wall Street Journal about the memorandum of understanding between OpenAI and NVIDIA, where NVIDIA had I think I don't know if we can call it an agreement, but it was a memorandum of understanding for up to $100 billion that they would invest into OpenAI. And Jensen, I don't know if you want to call it a hot mic moment, but there was a reporter who asked him about that, and Jensen made the comment. Jensen, being the CEO of NVIDIA, made the comment of, "Oh, no, 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 nothing like that," and that spooked everybody. And I think even Sam Altman had to go on to Twitter and just kind of reassure the folks that the investment's still going to be there. And so did Jensen kind of backtrack on that. But that was also a big moment this week. Did you catch that one?
I did, yeah, and we talked about this in our last episode too. It's like some of this is circular, relationship incestuous with some of these companies, the four, five, six big companies that are so reliant on each other that even if there's a little bit of a hot mic moment, it could spook some folks because the numbers are just so big. And when you're talking about NVIDIA and OpenAI and Jensen Huang and Sam Altman, like they're going to have so much influence on what happens here. And yeah, you're right. You saw both of them backtrack. I think there's also a rumor where people are saying, "Oh, OpenAI wasn't totally satisfied with the Blackwell chips," and then Sam Altman had to come out and say, "No, no, no, we're all good with these chips, and we're able to do what we want to do." So you're going to see this a lot, whether it's with these two companies. You saw Amazon and Google have huge capex expenditures in their latest earnings. You saw Oracle kind of caught in the middle. I think these companies are going to be looking at big, big numbers, big, big promises, and the slightest innuendo, either up or down, is going to have some kind of market reaction because there's just people are kind of right now everything is on hope. And so if you get a little bit of a scare or a little bit of a hope in either direction, I think it'll move. It'll move quickly.
Yeah, I'm glad you brought up Alphabet and Amazon because, yeah, that's what else happened this week, and it's just again more AI, right? More this the amount of dollars that are being spent on AI is just mind-boggling. Alphabet posted earnings. Investors didn't really like how much Alphabet was saying they're going to spend on capex, and even though they had some solid earnings, the future investment into the AI infrastructure for Alphabet's cloud was, I don't say spooked investors, but they were like, that's a lot.
It's big numbers, right? I think you look at both companies, both Alphabet and Amazon. If you take out this AI overhang, earnings were great. I think Google hit revenue all time high revenues of like 400 billion or something like that, and Amazon's doing super well. It's funny because we were chatting about this earlier. It's like literally a year ago, the market wanted to see big capex numbers, and if they saw a company not spending on capex, like Apple, for example, they would punish them, thinking, "Oh, they're going to fall behind." And now we're at a point where, okay, now the number's too big. And now Apple's being almost rewarded because they didn't spend on capex before. So it's like the market's going to be finicky. We can put things in context right now. I think it's clear there's a risk off position and there's panic. And so these numbers are coming out at this is poor timing, I think, both for Google and Amazon. But in the long run, you can't argue both of these companies from a consumer perspective and a B2B perspective have leadership positions and they need the AI spend now. It's kind of like, companies that were laying out fiber, in the 90s and 2000s. If you're going to go way back, companies that wanted to build infrastructure, physical or digital, that's part of the investment. And so I think you have to have faith in the fact that uh, Alphabet and everything they own, and Amazon and everything they own, that they are going to be leaders here, and they're making investments knowing that it'll pay off down the road.
Yeah, yeah. Hope so. I mean, one thing that also came out last week was the kind of story about Oracle not being able to provide, or I should take that back. It's not provide. The whole circular investment in AI. When Nvidia says, we may not do $100 billion with OpenAI, then OpenAI's obligations start to become in question, and so now investors are looking at Oracle, and Oracle's like, okay, we have these. What did they call them? It was remaining performance obligations. They have $523 billion of RPOs, which basically it's an accounting measure where they don't recognize the revenue, but they say it's almost like accounts receivable, right? Where we'll get it in the future. Well, that $523 billion is something that Oracle reports on. So investors, look at that number, and if you minus 100 billion out of that, I mean, that changes a lot of the story. And so now Oracle, has to protect its investment grade rating, right? I think it's triple B or something like that. And, what does it got to do that? Now, articles are coming out or stories are coming out saying they got to raise equity. So they got to now go to the market. And so this whole like circular thing gets kind of scary.
Oracle's kind of stuck in the middle because they're not making the chips, they're not innovating on the AI front. They're doing, of course, infrastructure, data center, compute, but it's so reliant on the other players, so that if you're doing this like musical chairs thing, Oracle could get caught, right? And if OpenAI may not deliver on something, it doesn't necessarily hurt them as much as it'll hurt Oracle. And I think that's what you're seeing. Oracle's essentially been cut in half since its all-time high last year when people got super excited. And now I think it's going to be a little vulnerable. It's going to be dependent on some of these other deals, which it's probably it's not used to being in that position when it was before, just kind of a regular, of course, great software company. Now these astronomical numbers are going to have an impact on its performance.
That was the AI, in a bunch for this
Yeah.
week. I think the other thing ending this week was, this. It's in the wealth management space now. Yeah, I love going to Barron's Advisor Center. Actually, I don't think it's called Advisor Center. It's like their advisor, tab on their website, just to see what's going on in the industry when it comes to like M&A. And we saw that RBC snagged an advisor team from UBS. What were their names? It was the Wilson Wealth Management Group, who managed like 400 something $1 million. And it's always interesting to see these teams moving from different shops and whatnot. And, the question is like, why? Why did they move? And, I looked into like, what's going on, because it wasn't the first time I've seen a team leave UBS. And I guess UBS changed the way they compensate their wealth managers last year. They have a different grid, and, some pretty bigger wealth management shops were not happy with how bonuses were being structured, and so they've started to leave. And UBS quickly changed that. They were like,
Yep.
okay, this is not good last year. So it's interesting to see, all these shops moving around and, where they're going, whether it's RBC or Wells Fargo or whatnot. But a pretty big shop left this week from UBS to RBC. Did you catch that one?
Yeah. So, on that note, I'll tell you from my side of the table at a home office, we listen, what we pay financial advisors is always going to be controversial. Financial advisors do all the heavy lifting, and they deserve every penny they get. When a home office tries to roll out a change in the grid, it's usually trying to reset some economics based on other expenses and trying to offset that. I've seen so many firms either try to roll out a grid and take it back like UBS did, or try to grandfather other folks in, or have it like more of a slower rollout because you don't want it impacting your advisor's wallet immediately. And when it does, you'll see a team walk out the door like this one did. So this happens all the time. I think teams leave big shops to go to other big shops, primarily because of finances. Because if you look at all the big shops, they have comparable product menus and tech stacks. On the other hand, and maybe this speaks to a lot of the folks listening here, some people leave the big shop when they just want to start their own company, right? Hang up their own shingle and say, look, we want to control the finances around us. So it's always interesting to see. You'll see the big names swapping teams all the time, but for sure UBS has taken more of a hit more recently. And I do wonder if is it just the grid or is it also part of the tech stack or what they're offering their financial advisors.
Do you wanna tell the audience, like, what is the grid?
Yeah, so it's most financial advisors are paid on a basis point perspective on assets that they have, right? So if I'm a financial advisor and let's just say I have $1 million in my total client book, I'm getting paid. The clients are paying on basis point perspective more likely than commission on a brokerage, but whatever the money that's coming in, your quote unquote home office, whatever shop you're part of, is going to take a cut of that. So the financial advisor gets most of it, but the home office takes a little bit just for operational administrative purposes. Keeping the lights on is what we like to call it, and that pays for a lot of the help that a financial advisor gets. Right, if you're at a big shop, you've got the tech stack, you've got specialists, you've got service centers, you've got administrative operational help. So it pays for all that overhead. And while the financial advisor gets again the vast majority of the pay, it's always a sliding scale. It's based on performance of, and when I say performance, that's stock performance based on, 10-year, how many assets you have, how long you've been at the firm, et cetera. So yeah, that's what we call the grid. Think of it as a square and there's tiers and rows and columns, literally based on those kind of factors.
Yeah, you never wanna mess with folks' compensation, especially in this era where you know, I keep saying it, there's gonna be more money to manage and fewer folks to manage it, and, if mess with the grid and folks are thinking long term, they'll find a better home, right?
Yeah. The financial advisor, the independent advisor, they're the lifeblood of the business. So while we're here, and I say we from a home office perspective, we're here to serve them and provide them the tools. We can't get greedy and take more of that money. So you're always going to see grid changes, compensation wars going on. And that's why people leave. They get paid somewhere else to go and, they might get an upfront bonus or something to bring their book. And, they'll go where that money is.
Yeah. Yeah, that's kind of like the weekly recap, but there's one more story that came out that I'd love to get your reaction on. It's kind of almost like the inverse of the whole UBS situation, which is Huntington Bank, or Huntington National Bank, which is located in Columbus, Ohio, decided to outsource their wealth management to Ameriprise. So it was some mind-numbing number like $28 billion. It's interesting that for me, rather than selling it or continuing to grow and invest in that, Huntington's like, hey, we're just a bank and we want to outsource this part of our business. And Ameriprise is like, sure, we'll take them. Did you catch that story this week?
Yeah, it's interesting. It's kind of the unwinding. I grew up in this industry in the 90s, early 2000s when you had this trend of financial supermarkets, and Citigroup was really the first one where they thought, hey, you, the consumer, will have all your financial services needs met under one roof. And I think what you're seeing here is maybe when that doesn't work on a more local, regional level. So Huntington Bank, strong brand in the Midwest, they do a great job with consumer banking and mortgages, et cetera. Maybe they don't do the best in wealth management in terms of services offered or what they can put into it from a market share perspective. You mentioned 28 billion for wealth assets under management. On their balance sheet, their consumer banking or their loan business probably dwarfs that. So they thought maybe, hey, why don't we stick to our knitting and do our core competency here, which is consumer banking, and let's leave the wealth management business to someone who is more of an expert and more in that field with resources, but without really selling it off, right? So if you mentioned like the trade off there, if Huntington Bank just sold it, um, they're now out of the business completely. And if a client walks in the door and gets a $2 million mortgage or opens up savings and checking accounts, if they want to also do wealth management and I'm the banker in the local branch, I got to turn them away. In this arrangement, I can still help them be the relationship person, but we're kind of handing off the expertise to Ameriprise. And I think you'll see that happen more often, especially when banks are looking at margins and trying to really double down on what they're best at doing. And if it's a consumer bank, and I read that same article you did, there are other banks too. I think you're going to see more of that on the regional side. After years of folks trying to invest and open up their own wealth management platform, it's something we always talk about. You got to invest in tech stack. Even if you keep the executive headcount relatively low, you still need licenses, you still need platforms. And if you can offload that to someone that's already built it and still get a little piece of it and say it's still your relationship, I think that's great.
Yeah, I wonder what the kind of customer experience is gonna be like.
I imagine it would be like a warm handoff, and that banker, he or she is not leaving the room. It's probably a conference. I can picture them having, maybe they're doing their quarterly investment review, but that Ameriprise broker is coming into the Huntington Bank office, and they're sitting all together. I think that would be the best approach to do this. You don't want to just completely hand them off.
Yeah, yeah, and I bet, I kind of funny ways thinking about, you go into your bank and there's that, kinda office. It's really a
Yes.
cubicle, and you sit down with your banker, and then they reach into their desk and pull out their kind of Ameriprise badge and put it on. They talk, they're like, "I'm a registered investment advisor now with Ameriprise, and I'm gonna help you out." And then you're done with the investing, and you take that badge off, and then you're like, "All right, let's get your checking account working
Yeah,
again."
no, it could literally work that way, where it's the same person, or it could be, they could have specialists in the branch. I mean, I was at Merrill Lynch when Bank of America bought us, and it was a great opportunity to put Merrill Lynch folks in the Bank of America branches, and it worked out great, right? So I think you can have both services in the same location. It's still the bank relationship, but now you're bringing in a investment person with another logo on their shirt, but it helps on both sides from scale perspective.
Yeah, so that's our weekly recap. I think we're gonna move on to kind of a more of a specialized topic, and this is gonna be a fun one because it's about the younger generation. We're gonna talk a little Gen Z over here. FA Magazine put out this news piece this week called "For the Financial Services Industry to Flourish, Firms Need to Step Up Their Support of Gen Z." And I'm always fascinated whenever I hear or read about new generations that industries are trying to target. And I feel, and there's no data to support this, but I always feel like those articles or topics or research reports just completely get it wrong, which is why this article is kind of nice to admit that first, that these industries are getting it wrong, and we need a better approach to the Gen Z folks, particularly in the investment advisory world. And I don't know if you've ever managed some Gen Z folks, Nishit, but they are different.
They're different. They grew up differently. They went through a few different black swan events that might impact what they do at work. Yeah.
Yeah, and so if you want the best and brightest, and you want to have that kind of human capital lens on your workforce, and I think the most famous thing that every CEO says is, my employees are my number one asset. Then you got to adjust, right? And these Gen Zers, they definitely do have a different perspective. I think what was common that I found with the working with the Gen Zers is, if you don't have a plan for them in their career, they quickly lose interest in the company that they're at. So you better have that lined up for them. But I also want to talk a little bit later about Gen Zers and as a client. Because they are different as well. And we chatted a little bit about it last week when you asked a question, about values, and a client didn't care about what was actually inside the portfolio. But I'd love to hear your thoughts on this whole like Gen Z and how to approach them and where we're getting things wrong. Just your overall thoughts on the Gen Z folks, either from a industry trying to attract them perspective, or from a client perspective.
Yeah, I thought it was an interesting article as well, and then definitely timely. I'll take the industry perspective, just knowing my experience, 22 years in various home offices, and seeing where it worked and where it didn't. I love your thought there on how it's super important and critical to have a career development pipeline there. Where I've seen things work the best, it's where we embrace that. You pair up mentors, you enable and empower the younger generation and those types of associates to not just do the work, but see how their work is contributing to like the bigger picture. Um, Everyone appreciates that, but I think for sure the younger generations are used to that more or expect it more. And they're also just more mobile, to your point, like I think in my parents' generation, my dad worked at the same place for over 35 years. Not saying he wasn't motivated, but he was getting what he needed in terms of big company and then what he was happy with. Today, I look at my own career. I think the longest I've been somewhere is 5 years, and it's always opportunities to move and take on more and have that ability to, value yourself and see what you're doing. So I definitely don't blame anybody in terms of younger generations. This is how people approach work, especially in our industry. The home offices that do it right, they benefit from a much bigger, better pipeline. I think of those places where I was, and I think of everyone that's come out of there, and they all have great jobs and they've grown tremendously. And then when I think of places that don't do it right, the pipeline lags, there's high turnover, the potential for folks that could have been promoted, they end up walking out the door because they're getting promoted somewhere else. They're not being empowered, right? It's maybe the same kind of cabal of people that are running all the committees and the initiatives. So to your point, the employees are going to be the most valuable assets of these companies, and they really need to embrace that and feed into that.
The thing that's kind of shocking, that was mentioned also in the article is that there was this early report about how many financial advisors are going to be in the industry, or actually I take that back. How many are leaving the industry in the next 10 years? And it was something like 37%, almost 40% of the advisors, whether it's a financial advisor, a wealth manager, in the single family office, multifamily, like 37% of them are just riding off into the sunset. And what was it? The Bureau of Labor Statistics projected that firms need to onboard more than 740,000 individuals to cover that. I mean, I don't know about you, but I don't see that many people trying to get into this space.
Yeah, and we touched on it last week. I think there's two solutions really to that. One, what we talked about last week was the tech stack and technology. Making folks that are still here more scalable, more efficient, take on more work. But the other part of that too is enabling the younger folks entering the industry. I think that same article touched on, hey, there's still interest when you go to college campuses and business schools for graduates to enter the financial services industry. Um, but when they come in, what are they expected to do? Hopefully they're not turned off right away. Hopefully they don't see that they're just doing, one thing and don't, like we've talked about, don't see that arc, don't see that development effort. If they're getting that, then they're going to stay. And I think part of that is, embracing how you recruit on campus, but then what you do with those folks when they come in. We're not going to get 740,000 people. But, if we get half that, a quarter of that, whatever we really need to do, along with the technology upspend and ability and efficiency, then maybe we can make up that gap.
Yeah, what do you think about the urgency to attract young talent? This is since we're focused on Gen Zers, to get those Gen Z folks in the door. Because when I was at my old firm, we used to recruit at several campuses, and there were a couple on the East Coast where we couldn't get we couldn't get more than 2, not even interviews. We could just applications. And so, my boss had tasked me, he's like, "Go figure it out," like, "Why?" Well, like, we're a pretty good brand, why aren't these college kids, picking us? And I went there, what I found was that we were recruiting for seniors and, potentially juniors, but we weren't gonna go further than a junior. And these large, like, money center banks, the JP Morgans, the Goldman Sachs, the Morgan Stanleys, and Bank of America's, like, they were already recruiting at the
They
freshman
are.
level. The freshman level. Like, they have these kids on a track from day one.
Listen, I can tell you from my experience, working in places like Merrill Lynch and Morgan Stanley, I'd have friends, family members say, "Hey, we have a senior in college, like he or she's looking for an internship." And I'm like, "You missed the boat. It's not even incoming seniors or incoming juniors." Like, you're right. We had programs at Morgan Stanley where we would do a 1 week residence for high potential freshmen. And when one bank does it, the other bank, it's very competitive, right? So if one bank does it, the other bank wants to get in there even sooner and sooner. So yeah, the urgency is there. And it goes back to what I was saying is, like, you want to build a pipeline. Where I've seen this be most successful, we had pipelines of undergraduate interns, business school interns, and then graduates as well. And all those folks did well and got promoted into higher seats. And there's a sense of like, hey, I grew up in this company, there's pride. And then they become mentors to the newer generation of interns and recent graduates. So it's definitely a cycle worth investing in. And you're seeing that happen where these big banks now are on campus earlier and earlier, right? Sooner and sooner. So if you're going there to look at seniors, I think most of those seniors hopefully already just have offers, right? You got to get there way earlier.
Yeah, absolutely, and I'm just thinking, like, if you're an independent RIA and you're competing against, you know, JP Morgan, I mean, you gotta compete in different ways than just, showing up at the, career fair and having a
Hmm.
booth and whatnot. You're a much, much smaller fish in a very, very well, a shrinking pond actually. And, what do you do? Do you have to, start volunteering at the university?
Well, I think what you can do, yeah, that's a big part of it, right? Like I think you have to. Hopefully, there's some alumni at the school or campus that you're targeting. I think ask for volunteers from your own company, even if you're a small, medium sized RIA. Go to those schools where you have alumni. Also, I think what helped, what I've seen on both sides as a student, as a business school student, as well as someone, I was heavily involved in campus recruiting at my alma maters. It's hitting the clubs, right? There's a finance committee, there's an investment committee. Um, there's treks, if you're in the Northeast or on the West Coast, it's easier to get to some of those cities in the Midwest around Chicago. But some of these other colleges, maybe those kids don't want to go far away. And if you're an independent RIA, not necessarily in New York or Chicago, you have access to maybe good schools in your backyard, and maybe some kids want to stay there and not travel. So it's a little bit of everything. I think you got to start sooner. You have to cast your net wider, and you have to be a little bit more creative with just who you're approaching. To your point, you can't just have a table with some tchotchkes. You have to network into some of those student organizations as well.
Yeah, it's funny that you brought up the whole clubs thing because it was like a fraternity for one of the schools that brought it to light for me that, we're too late.
Yeah.
The gentleman and the gentlelady on the other side of the Zoom call was like, "Where were you at 3 years ago?" I'm like, "What? What are you talking about?" Like, "Yeah, we're already recruited, like, we aren't looking at anywhere else." And it's funny because, I was coming from the buy side and they were being recruited by sell side, and I'm like, "Wow, you could totally skip sell side and go straight to buy side," which is what everyone wants to do in their career on the on the buy side. So,
Well,
it's it
I think that's part of it too, is just the education part of it, right? Like some of those kids don't know. I was lucky enough, my first job out of college happened to be on the buy side, but the bigger names are always on the sell side. And like, that's what you think is there. So to your point, everyone gets, earlier and earlier, and all about communication.
yeah, and your brand matters. I mean, because that's
Of
how they
course.
were
Yeah.
crushing us is, how do you compete with Goldman Sachs, right? Like, that's a name brand. You had mentioned earlier about keeping, your job for up to 5 years and then moving on to another one, which actually is a great strategy because your income level, I mean, there's plenty of studies out there that say if you really want to see significant growth in your income, you gotta leave your job for another one. But there's this misperception that Gen Zers are mercenaries at their jobs, when in reality, the what thing that I found also, not including in this, article, was that they're very mission driven. So if your company has a purpose that they really agree with, or they can buy into, or they can, really support in their own way, they really will dive into that company and, be the best employee as they possibly can. But if it's not mission driven, at least if they don't perceive it as being mission driven and it's just you're selling a generic product or whatnot, they tend to fall off. Do you agree with that? What they were saying in the article about that?
I think that's a niche segment, especially in our industry, because you can say, of all the brand names we just mentioned, what is their mission? Um, Everyone, I think in finance, our mission is pretty black and white. It's to help our end clients. It's to help our financial advisors, our clients' goals, and meet those goals. How we do them, yeah, you want to feel welcome and be represented and seen and heard, right? So there's a lot of these employee organizations that do that. If you feel comfortable being who you are in a large company or even a small, medium sized RIA, um, you're going to feel valued. I think in terms of mission, it might help you maybe get you in the door and feel good about where you're working. I know for me, we talked about moving around. If it was basically like hitting a ceiling, right, or being miscast or spinning my wheels at some point, I was looking for opportunity. And then with that will come compensation. But you want to have a mission. You want to be somewhere where you can be proud of working there, but you also want that opportunity to be contributing. And once that, if that opportunity dries up or you're stuck, I think it doesn't matter what the mission is. You're going to be there doing the same thing over and over again. If you feel like you're being, like I said, miscast or underused, you're probably going to start looking elsewhere. So, mission is super important. Not to downplay it, but I think in our industry, the mission across all those brand names is pretty similar. Unless you're going specifically into ESG investing or some kind of value investing where you really believe in what you're doing and what's being invested in, which is totally fine. And a lot of these companies have that as well. I think on the micro personal level, you have to make sure on a day to day basis, you feel valued and satisfied.
Yeah, I think communication sheet is just super key in this
Yeah, of course.
situation. I think back in the day, maybe it was everyone assumed you knew what the goal was, which is, build your client's wealth. And, you didn't really need to be clearly written out. But these days it does, especially for this next generation. They want to see clearly, like, what is, like, what are we doing here, guys? And so having, even as something as simple as like a mission, vision, values, like statement on your website before the new, employee joins or is even applies to join is super important because
Yeah,
that question of like, what are we doing here is something that's in a lot of Gen Zers minds
sure.
that I found.
Yeah, a lot of these big banks have, core values, right? I can remember both at Merrill and Morgan getting through the onboarding, and it's 4 or 5 pillars of, client first, do what's right, community, all those things. So, and that was always front and center during recruiting. So you're right for that, younger generation, especially when they're entering the industry for the first time or joining a big brand for the first time. That's super important.
Yeah, and it'll help you keep them too because they know exactly why they're there, and if somebody tries to poach them and they don't have a great, mission statement, they'll
Yeah,
say,
exactly right.
"I don't know if I wanna jump ship, and I don't know if the grass is greener on the other side," but yeah, so that wraps up our special topic sheet, and this we get to
Great.
one of my favorite parts of the show, which is what are you looking forward to, next week, and, what are you a little concerned about?
Yeah, well, I guess I'll take the latter, just with the risk off on the panic in the market. I saw this morning there was a little bit of a bounce. I think what I'm looking forward to is seeing. Let's see if we can build a floor here. I was a little concerned as we talked about last time. The metals have corrected. Crypto has not. Tech stocks are down. There's a kind of a sense of fear and panic in the market. So I'm interested to see what happens this afternoon, what's written about over the weekend, and really what happens on Monday, as we enter a new week. Because again, we had what I think is a relatively strong earnings from bellwether companies, and really the sell off was based on the capex spend as we talked about. So, um, I'm concerned about building a floor and seeing what happens if people are buying into this bounce for real, or are they going to sell into the bounce? And I think we'll have that answer this afternoon, or definitely by Monday, Tuesday.
That's great. Any concerns about Bitcoin?
I, I'm no Bitcoin expert. I think it seems like it's trying to build a floor in the low 60s. The one thing I have more faith in probably is the institutional money. I don't own any cryptocurrency itself directly, but I do own some of the ETFs, and I feel like that's an exposure in some of these retail portfolios that those folks are not those institutional portfolio managers are not dumping it this week. It's an allocation to a 60/40 model, just like fixed income is, just like commodities are for folks. We're talking about Gen Z people, right? Like they look at crypto as a key component of their balance sheet, just like maybe, older generations looked at gold or commodities or fixed income. So as long as those people aren't panicking, I'm not panicking. I feel like it'll settle here soon. But definitely want to see some strength in that going forward.
Yeah, I'll never forget when they started calling, the pandemic checks, they started calling them stimmy checks,
Yes.
and then they they started like, all of a sudden, crypto went wild. But, no, that's great. Thanks for those concerns, and, as we've said before, we don't give any investment advice on this show. This is all educational, and However, if you are a registered investment advisor or broker dealer or someone who works in the asset management space, we can keep this conversation going at Inflows. So please join us at inflows.com. You can sign up there. It's free to use, free to join, and we'd love to have you on the platform asking questions to Nishit. He'll be available there. If you have any questions about some of the comments he made here, feel free to join us and leave a comment. Other than that, that wraps up our show. I want to thank everyone for joining us on our second episode. I hope you enjoyed it. Please like and subscribe on YouTube, Spotify, and we'll catch you all next week. Thanks, everyone, and thanks, Nishit.
Yeah, thanks, Yasu.